Greetings and welcome. First, let me introduce our company's co-managers, Robert Bubb, Mark Ortiz, and myself, Leah Matthews. We are Group G and are part of Industry 2. We'll be presenting to you today about our company named Soul Support. Our strategic vision. At Soul Support, we are committed to competing for global market share, becoming an industry leader, and increasing the company's earnings year after year. We want to provide affordable and high-quality athletic footwear to compete with the market and focus on consumer interests and needs. We want to offer the finest athletic footwear on a global scale to reach our customers at retailers, wholesalers, and online through the most cost-effective manner to create value not only for our shareholders but for our customers as well.
Initial competitive strategy for both internet and wholesale segments for years 10 through 13 was in line with the best cost provider strategy outlined in our text. We wanted to give our customers more value for their money by offering a broad selection of affordable and high quality shoes. Our initial plan was to have a variety of models available and remain consistent with the quality of the product we provided. From years 10 through 13, we maintained an SQ rating of 5 stars and kept the number of models we offered to the customer at over 200 pairs for the majority of that 3-year span in both our wholesale segment and internet segment. We kept consistent strategy across all foreign markets and focused heavily on advertising. In 2014, we decided to change things up. We began to scale back our widely differentiated product line for a more focused product offering approach. At this point, we had not moved into focused low-cost strategy, but rather an overall low-cost provider with a larger product offering than our target competitor, Company E. We decided to reduce the number of models we offered to the customer to increase our product focus. The total number of shoe types we offered decreased from 150 to 50. We began phasing out the use of superior materials for our branded shoes. This allowed us to reduce and better control costs and increase margin versus unit price to the customer. With this new strategy, we continue to have success in the internet segment, being among the companies with the largest market share. Our wholesale segment market share was a different story, with decreasing market share and a large number of stockouts across all markets for the years 15 through 17. We were continuing to see our market share shrink again in the wholesale segment, partially because we had shifted strategies and required time to adjust to the new pricing approach. Our competitive strategy in the private label segment was to gain market share by offering great quality shoes at competitive prices. For the most part, our strategy mirrored that of brand production up until year 15. In year 12, we did not compete though. We had shoes available, they were not allocated for sale in this segment or any other segment, and Company C owned 59.7% of the private label market. In year 13, shoe production was allocated for the private label segment, and we ended the year with a 17.8% market share. Up to this point, we really hadn't looked at private labels as being a money-making segment given the small volume that was being sold at the time. We only had shoe production allocated for sale in the North American and Asian Pacific markets. In year 14, we dropped the ball, however, and did not assign production to private label, and we lost those sales. This was a huge learning curve for us this year, and those lessons allowed us to find traction in the following years. In year 15, we made sure to assign production to private label and saw an increase in our private label market share from 0% in year 14 to 13.2% in year 15. Though our market share was still not on par with our high watermark year of 17.8% in year 13, it represented a shift in approach. In previous years, private label was not a large consideration and only represented a small amount of projected surplus production capacity the wholesale segment did not need to meet its projected demand. That meant that wholesale was the primary recipient of production and private label just got the leftovers.
For our total revenues, we started off the first couple of years with steady increase of 22% and 12% from year 10 to year 11 and from year 11 to year 12. In year 13, we saw a decrease of 6%. I believe this being a result of not creating a unique strategy for our company and continuing to follow the best cost strategy we initially started with. This was also the first year we saw a loss due to stockouts. The following year, we saw our largest decrease in the amount of 11%. We did not assign production to private label and we lost those sales, and at this point is when we decided to apply a different strategy for our company, and the initial entries would show results the following year. As you can see in year 15 with our new low cost strategy, we were able to bounce back and saw an increase of 19%, bringing our total revenue to $338 million. We saw a small increase in year 16 of 2%, and in our final year we again saw a significant increase from 17%, allowing us to finish with a total revenue of $405 million. Factors like capacity and our cost strategy played a key role in the development of our revenue throughout the years. Much like our total revenue, our earnings per share showed steady increase throughout the years, for the most part remaining above the investor expectations. We started off strong by increasing our EPS by 37% in year 11 and an amount of $3.43, and saw a small increase of 6% in year 12 to $3.64. However, in year 13 we saw our largest decrease in the amount of 23%, leaving our EPS at $2.81. We saw a significant increase the following year in the amount of 35%, bringing our EPS back up to $3.79. After year 15, we saw a substantial increase in our EPS with a combined rate of 60% for year 16 and 17, nearly doubling what was expected by investors in those respective years. With the exception of year 13, we were able to exceed the investors' expectations every year in order to maintain a good overall performance for the company. Unlike total revenue and earnings per share, global market share was more inconsistent throughout the years. We saw our largest market share in year 17 in the amount of 12.8%. When looking at the results for total revenue and earnings per share, it doesn't appear that they would have a direct relation with the global market share, as for both total revenue and EPS on year 13 we saw our largest decrease, but in global market share, the largest decrease came in year 14 in the amount of 16%. Going from 11.8% global market share to 9.9%. Although it might appear that there is no direct correlation between these numbers and the previous two slides numbers discussed, the factor that came into play year 14 is that we did not assign production to private label and we lost those sales and market share. In year 15, we saw our largest increase as we took a different approach and were able to gain internet and market share from competitors. Similar to total revenue and earnings per share, stock price had an upward trend and had the same results in year 13 with a substantial decrease of 39%, going from $51.58 to $31.67. Although after year 11 we began to see a decrease in our stock price, we were still above the investor expectation for a majority of the BSG game. After year 15, we had our largest increase of 169%, going from year 15's stock price of $49.32 to year 16's $132.47, nearly tripling the prior result and the investor expectation result. Any investor would be more than happy to see the kind of result that was produced. We ended up our year with an additional increase of 22%, leaving our stock price for the year 17 at $161.15. Factors that played a role in our stock price seeing a significant increase was constantly having an overall good credit and image rating. To provide a background into the thought process for our strategic planning, we began looking at year 11 and noticed that our expectation was that we would be able to follow a best cost strategy throughout the game. To achieve this strategy, our first expectations were to keep costs low by minimizing extraneous expenses that did nothing to improve our bottom line, improve our SQ rating, or increase our public image. That is to say, if it cost too much to see a result, then the course of action was not to take it. Initially, this approach was successful. However, what we found out in taking this approach was that a significant number of other companies were taking the same approach and squeezing the market and making this strategy too difficult to find traction with. Following suit with the leading team, we switched to a low cost strategy but chose to differentiate our product with slightly higher quality and maximize production efficiency without building additional production capacity unless it was called for. We ultimately wanted to lower costs, maintain a positive image rating, increase revenue, EPS, and ROE. We would do this by focusing on production, pricing, and market share. We wanted to see significant increases in EPS, ROE, and stock price that would exceed our investors' expectations. In the end, we ended up surpassing the target goals we set for ourselves and did so by following the low-cost strategy and increasing our revenue growth, reducing the number of models that we offered, and gaining additional market share from the competition.
When looking at the competition in the industry, Group E is who was constantly at the top of the industry scorecard. They were able to create a unique strategy from the beginning that set them apart and allowed them to gain market share comfortably, offering the lowest prices and smallest number of models offered by any company. They were in a way the Walmart of our industry, and in order to compete with a Walmart, you have to build your own Walmart. So we tried to come up with a strategy similar to theirs, as our previous strategy was too parallel to the other companies, and we were all fighting for a small market share and over nickels and dimes with regards to revenue. We decided to apply a low-cost strategy to pull away from the other teams that we were sharing a market with, and began to offer less models and reduce costs and sell prices. Although Company E was already established and it would be hard to compete for their market share, we were able to stay in between a $1 to $2 difference in earnings per share for years 15 and 17, and we were able to beat them out on ROE in year 17. Our credit ratings were somewhat similar across the board for years 15 to 17. Towards the end, when we were able to separate ourselves from the other companies, we mirrored Company E in that we controlled the internet market segment and they controlled the wholesale segment. Coming up with an initial strategy was difficult, given that you are trying to plan for how the market will react to your product, and additionally trying to figure out your competitor's next move that could directly or indirectly affect your company. We learned that you have to start with a well-defined plan to not only be competitive, but also unique in the sense that you'll set yourself apart from the rest and not fight over such a small market share. We learned that there's never a time to be relaxed or comfortable, even and especially when you're successful. You should constantly think of new strategies to give yourself an advantage over the competition. The earlier you gain that advantage, the better off you'll be. We learned that you have to be ready for anything. In year 13, we had significant unexpected decreases to our total revenue and earnings per share that backtracked sole support and allowed competitors to get ahead. When we decided to change from the best cost strategy to low cost strategy, it improved our numbers drastically. We learned that lower prices and limited models was important to gaining market share, and that depending on the industry, some customers were more concerned with pricing than quality. There is no one winning strategy. In order to be successful in this game and remain on top, you have to analyze your market and competition and constantly change how you want to approach the year. Thank you.